Good morning, everyone. Welcome back to another Market Open live stream. So today we've got a little bit of red in the markets. We've got some uncertainties brewing again. We got the Dow down 0.05%, mostly flat here. It's really technology that's getting beat up more here with 0.53% to the downside. Oil up another 2.16% here. In fact, if we check out Brent, we're knocking on the door at 85 here soon. We're at 83, 87 right now on Brent. And on our bond yields here, we're sitting at 1.61. There's a crazy divide in the marketplace, as has been true for the last 6 to 8 months. A lot of fear about that inflation just staying longer and being larger than expected. Although we did just have someone from the ECB, the European Central Bank, mention that they're not even close to the potential conditions for tapering, but that the market's just recalibrating, which makes you wonder, is this just sort of like a new way to sort of describe what's going on? Oh, don't worry, there's no inflation. We're just recalibrating. Who knows? But market's a little tenuous because of that. Also seeing some pain at the airlines. A lot of cancellations this weekend. I flew out of Vegas, and there were many people who were trying to fly out of Vegas, and their flights were just canceled. Heard 27% of all Southwest flights over the weekend were canceled throughout the United States. That there were now sick outs instead of like walkouts. They're having sick outs where people are calling in sick in sort of a coordinated attack on institutions as a way of expressing their frustration for vaccine mandates. So that certainly doesn't help get things moving more efficiently. As a result, you've got things like Southwest or stocks like Southwest down 3.29% right now, and I would say another headwind that's really coming to the market. Because we do have our CPI sort of lingering indicator this week of what the rest of this year is going to look like, right? But another thing that might be weighing on markets as well is the fear that, okay, well, we know we've got some inflation that's lasted longer than expected. How is this going to affect earnings? Earnings obviously very important for the stock market. We've had a year, well, not a full year, calendar year, but 2021 so far, where good earnings have been rewarded with stock drops. We've seen pretty nonsensical earnings in maybe inflation. Safety stocks actually end up leading those stocks to do much better. In other words, the market seemed much more willing to buy into any kind of hope for stocks that could be deemed an inflation hedge, whether that's defensives or industrials. But we have seen some of that relax here a little bit as we've gone into the fall, thinking that technologies were their opportunity now, or had their moment to shine as inflation would inflect down. But again, we just haven't seen that inflection to the downside yet. So that's what we'll be waiting for. If we'll get it this Wednesday or not, who knows? At this point, it feels somewhat almost potentially unlikely that we'll see an inflection down, just given how much uncertainty there is in the market around pricing. And remember too, we mentioned we have this what's it called? We have the situation where companies can't raise prices as much as we've seen in terms of costs actually going up. So, for example, if companies raise their prices $10 for a product that's usually $100, let's say, it'd be about 10% inflation. Let's just say, right? But if their costs actually went up by $15 and they'd really like to raise their price by $20 or $25, then we're in a situation where the company is taking more of a loss. Margins are getting squeezed. And when we look at earnings, we're looking at that pricing power, and we're looking at margins. We're trying to determine, are companies able to raise prices to get through this, or are they not able to raise prices as quickly? Because, see, the thing about raising prices is in a free market, you have competition. And so you kind of have to staircase up. And what I mean by staircase up is one company, let's say, is trying to raise prices $25 from $100, and another company from $100 is trying to raise $130. Well, the one at both are at 100. One can't just go, okay, we're 130, because then all of a sudden the other competitor becomes much more desirable, and that just shoots the company that went to 130 totally in the foot. So you kind of get this gradual increase where oftentimes both of the companies, in this simplified example, are raising prices slowly, but almost in sync. 105, 106, 107, right? And they're moving these products in sync, kind of like gas stations sometimes do. But although they seem to be less competitive about each other and more competitive with what the actual market is doing. But the point is that these pricing increases could last much longer because of this sort of stair-stepping effect of how corporations raise prices to stay competitive while at the same time trying to merge or to maintain their profit margin. So, all right, let's take a peek here. Hyliion down 6.52%. There must be some news with Hyliion. Not one of my favorite companies. I think the truck retrofit industry is going to be very short-lived. But hey, what do I know? I'm going to take a look at the news quickly. For Hyliion, we have, let's see, UBS downgrade on slower, more costly ramp up. And UBS now downgrading them to a $5 price target. Ouch. Southwest down 3.69%. NASDAQ down 299, not the index. Cloudflare down 2.48. Arrival 2.14. Robinhood's down almost 2%. Outlet still bobbing around that 420 region here. Lemonade 1.2% to the downside, sitting at 62.76. Airbnb down 0.81. AMC down about 0.75%. Enphase down about 0.75 as well, along with Pinterest. Etsy sitting at 0.65. Let's see here. Amazon, DocuSign, these guys down about 0.4 with Palantir. Disney's down slightly. Target, Dave & Buster's down marginally, getting closer to that 0% level. I have not yet seen where our Tesla sits. Tesla is actually up 0.03%, essentially flat. Looks like Matterport's down about 0.5%. To the upside, you have Shiba Inu. What looked like it was starting to recover somewhat. SHIB right now, yeah, look at that. It popped up to about 3,500, sitting right now at 29. And this is, let's go to the hour charts. This is usually a shorter chart. There we go. So we've kind of been sitting in this trough over here, bouncing around between 24 and 25 for the last day and a half here. Did go as low as 20 on the 7th, but slowly coming up again here, bouncing over its support line here. Affirm, this pretty incredible. Affirm's actually up 0.42% here in it looks like the pre-market. All right, so let's see what we've got on other headlines here. So let's see here. Let's jump on into the Bloomberg. We'll just go to Bloomberg.com for this part. And let's see what we have here. So, okay, surging oil is what they're suggesting here as one of the leading factors. Aluminum hits 13-year high. WTI crude rises above $80. Yeah, there's always this fear about potentially a commodity super cycle. And yeah, Alibaba was doing well as well. I think they were up like 4 or 5%. Let's see. Let's take a look. Yeah, Alibaba recovering more quickly than NIO. Let's see here. Baba. Yeah, Baba about 5% right now. Very nice. Very nice move by Alibaba, coming off that 138 low pretty solidly and fast. NIO up about 1.2%. But gosh, NIO moves about 1.2% for every 5% Alibaba's been moving. So good job for Alibaba. All right, let's see here. All right, so then we've got, okay, yeah, let's go back to Bloom and see what's going on with the commodity talk here. Is China's coal futures reached a record as flooding shuttered mines. Aluminum rose to the highest level since July 2008, leading broad gains among base metals. Contracts on tech-heavy NASDAQ underperformed the S&P. That's true. You get NASDAQ under the S&P right now, which usually the NASDAQ overperforms or outperforms, I should say. Fuel shortages in China and Europe are bolstered by higher inflation, or the case that higher inflation will persist beyond expectations of central bankers. I think this is, at this point, just a foregone conclusion that inflation is going to last longer. I don't know that necessarily means Mr. Money Printer Jerome Powell's wrong. It just means things are going a little slower in inflecting the way Jerome believed. We see rising risk to global growth and evidence of more inflation, says someone here from Fidelity International in a note to clients. Earnings boost fading. Look at this. Earnings boosts, global earnings revisions losing upward momentum. So less revisions to the upside in terms of forecasts and estimates. Upcoming reports on third quarter company profits are seen as the next potential pressure point in the market already under siege. The coming earnings season or session, whatever season in the U.S. will be heavily scrutinized for pricing powers, margins, and clues on the shortage situation, as well as wage pressures. This is true. When we review earnings, one of the beautiful things about reviewing earnings is we can read investor transcripts, investor call transcripts. I personally enjoy reading them versus listening to the calls. But sometimes the calls are worth listening to just to, hear the sort of reaction. Like how did these executives live react to some of the questions? And so doing a mix of both, I think, is good, especially in the really juicy ones. A lot of the manufacturers, like 3M, really Procter and Gamble, GE, General Electric. These are great ones to listen to because they always get asked about inflation. It's almost like that's your like core inflation kind of segment. Enphase, that's another one that'll get asked hard about inflation because it's the supply shortages and pricing power are going to be huge factors to their bottom line going forward. Even though we know a lot of this is temporary, the temporary is lasting quite a while. Any retreat in U.S. stocks presents an opportunity to buy the dip, according to strategists of some Wall Street big banks who argued inflation fears are overblown. And this is that two-sided argument we have, which actually creates opportunities for both sides, right? When you have sort of one side of people going, "There's no inflation," and another side going, "There's lots of inflation," that difference creates the tug and pull that we're seeing in the market. It creates that sort of you can almost see it as like a magnetic force of repelling each other, and that oscillation of back and forth creates these opportunities in lower stock prices, and they come and go. It's kind of fun. The way I look at it too is just build your exposure, build your asset base. Is my belief, certainly, that the goal is to own as much as possible in terms of shares, and the stock prices vacillate so dramatically in the short term. Getting in at low entry prices is the goal. All right, let's see. Crypto, 56,000 on BTC. Let's see, BTC, Ethereum. Yeah, look at that. Bitcoin sitting at, just briefly hit 57 here, and now sitting at 56,600. And Ethereum right now is sitting at almost 3,600. We did briefly drop there for a moment to about 33.85, but that was about an hour yesterday where we got down to these this just below 34 figure, and for a brief period of time as well. So then we've got Cardano ADA sitting at 221. Good. So what else do we have? Steve here says the Reserve Bank should provide a timeline when they say transitory. I think the problem is they just don't have a timeline. It's what they're doing is they're saying, hey, look, we're looking at the underlying aspects of inflation, the underlying pressures, and we believe them to be in transitory markets. For example, used cars. Yeah, let me see if Manheim is updated at all. Take a peek here. When you see that used car prices are up, you know that can't last forever. You can't get a surge in used car prices month over month over month of 10%, 10%, 10%. But wow, right now they're actually even higher now than where they were at their peak in May. That's incredible. It's gotten worse. So I last looked at this index. I'm going to put up a picture here in 1 second. I last looked at this index in, hold on a second. There we go. Let's see here. Follow Nancy Pelosi's buys. The problem with Nancy Pelosi's pies, or her buys, not pies. I'm thinking of M1 Finance. Problem with Nancy Pelosi's purchases is usually have a 45-day delay in when you actually see what those folks are buying. But anyway, yeah, take a look at this. So we've been thinking that used car prices would inflect downwards, and they have, but they started coming up again. Now, they didn't originally go back to their May pricing when we last looked at this Manheim Vehicle Index, which is an index that tracks used car prices as of last week, is when we last looked at this index. And we thought, okay, all right, so there's an inflection back to the upside in the Manheim Used Vehicle Index, but that's okay, so it came back up a little bit. It's not going to keep going, is it? Haha. Well, look at the chart right now. So here's your May pricing. This was sort of that inflection point to the downside in the shelf we hit. The used vehicle index as of today is now actually a chunk above where we were in May. In May, we had a reading of 203, coming in now at almost 205, which is incredible because we were expecting this to rotate to the downside. Now, right now, that is only a percent, but the chart gives us an idea of potentially this inflection point again in the market, where we do see prices that came down temporarily as expected, but then as not expected, are skyrocketing back up, and that's not good. Let's take a look at lumber just as another example here. Take a look at this. Wow. The LBS now back over 700, almost back to 725. This is lumber. If we zoom out to the 6-month, we'll see this massive plummet in lumber prices, but it's really not until when you go out to a year or even the 5-year chart that you see this incredible spike here with the pandemic. Yeah, the pandemic, I would say, well, let's see, recession. Let's see if we can find it. So recession's right here where my mouse is, where we went from lumber prices of about 446 down to about 300. Lumber prices then proceeded to skyrocket excessively to about almost 1,600. That has substantially fallen since in the last 6 months here, but which just drop was expected. The drop is definitely expected. However, what again is not expected is the fact that look at the last month here, folks. We've been straight up in lumber prices again. And this is the danger that we're facing right now, is we're facing this scenario where, golly, we thought prices were going to go down. They started going down. Everything started suggesting that central bankers were right. Inflation was temporary. Everything was going to be transitory. There were going to be two big sort of bouts of inflation. There was going to be one when we compared base effects. That was going to be April, May, June sort of data that came in. And that's comparing to the whole of the prior year to see a year-over-year boost in numbers. And then the second was going to be the reopening, that we would see a surge in spending at reopening, but then we would see a subsequent slowdown. And we actually did. We saw a surge in spending this summer. And then as we started seeing Delta come back, we actually saw a slowdown in consumer mobility, in spending, consumer confidence. Everything really rotated back to the dark side around the end of August, the end of July to the end of August. However, as Delta has vastly dissipated, we're again seeing somewhat of a resurgence, and now we're seeing flight cancellations, supply chains stressed more than ever before. Things aren't getting better. In many cases, they're getting worse. Shipping timeframes and freight timeframes are worse than expected. You look at the Port of Los Angeles, usually has one docked freight ship, now has somewhere around 80 docked freight ships waiting to be unloaded. All of these things are driving prices up. And again, we're seeing this inflection here in not just lumber, but in the used vehicle index. Aluminum's also at an all-time high right now. It's somewhat unbelievable how persistent the inflationary powers have been. And earnings are going to reflect pain because of this. And I think this is why you are starting to get some more downgrades as well before we head into the earnings cycle, as institutions try to sort of call the inflection to the downside so they can show that, oh, we're right. But anyway, yeah, it's going to be a big issue that we're going to have to pay attention to, or the inflationary fears. Now, I will say the markets are surprisingly resilient in how they're pricing inflation. If we go to the 10-year treasury bond and we look for rates, we can oftentimes see this as a little bit of a forecast of what the market thinks inflation is going to do. And what was very interesting was we spent some time kind of stuck at about 150 to 155. And there were a lot of forecasters suggesting, okay, we're not going to go back to that 172 or whatever that we had previously. We're just going to level out by 1.5 to 1.55. And that always seems like it's an argument of forecasters, is that, oh, if things are going wrong, don't worry, it's just leveling out. It's just temporary. Yeah, well, now we're at 1.61. Let's see what the 10-year break-even's doing. 10-year break-even treasury rate. So 10-year break-even, nice way to also look at what's happening in terms of inflation expectations. And basically, as this inflects up, inflation expectations are going up. So take a look at this right here. You've been pretty flat here on the bond market. Really from April through about September. You've been relatively flat with the exception of a little pop here in May. And then, of course, we're going into the beginning of the year, we saw a nice rise here in the 10-year break-even rates. We're finally starting to see an inflection up again in how this is being priced. And when you see, it's a little easier to see it here. You can kind of see this little trajectory here since about September 22nd, where the 10-year break-even's moving up again. And if I zoom in a little bit more recently here, since the 22nd, you can really see this nice move to the upside here. And again, here's May. And again, this is the 10-year break even, which tends to be a little bit of a forecast for what the market believes inflation is going to do. And we are getting a very similar May-esque style push, which it's worth noting that in May, we had some pain in the markets. Some stocks dramatically oversold. For example, take a company like Enphase that in May sold down to as low as about 108, 120, as opposed to really trading mostly sideways around that 150s where we've kind of been. And this was actually such a low sell-off that you had the company itself buying its shares back as they saw it as relatively oversold. So, which ended up, of course, being a wise play. But look, it's everything, and now folks are even suggesting that Biden's vaccine mandates for companies with over 100 employees are going to lead to even more worker shortages, more labor shortages, a lower labor force participation rate, and more service-based price inflation. Which one of the big fears for inflation is service-based pricing. So we'll have to keep an eye on that as well. Service-based pricing and rents are going to be two of the major factors that lead inflation to potentially inflect up. Plus, of course, some of our OGs like car prices, which we've seen car prices now move up. Here's actually a comment. We'll throw it up on screen here. This is an interesting comment. It sort of piggybacks off of my talk about a lot of folks getting their flights canceled this weekend. Southwest having about 27% of their flights canceled on this sick out movement, where people are calling in sick in protest to vaccine mandates. Here's a comment. Both of my parents work for the airlines. I think it's funny if people in the industry say the airlines. American Delta and regional air traffic controllers are planning more sick outs before they're laid off for no vaccines. Half of pilots are ex-military, something to think about. Yeah, it's incredible. So let's see here. Here's so for example, some other comments here in the chat. I would quit my job before I ceded to a vaccine mandate. Well, it's going to be interesting, folks. We've got some serious headwinds. The vaccine mandates certainly are not helping. It's also not great news that there was a headline this weekend that Merck's Red Pill, their COVID emergency pill, might have to be partnered with other drugs to be most effective. Now, that is pretty common to have some sort of cocktail of drugs, but it's not what was initially pitched or discussed, although that was deemed a possibility. And some see that as a negative catalyst, since the Merck drug was seen as such a potential boon for recovery stocks and the reopening play. Anyway, let's go ahead and take a look at some sticks and see what we've got. But yeah, lots of things to think about. So let's see what if anything is sitting green right now, other than crypto, which we do of course expect crypto to continue to do well as inflation fears mount. And crypto does appear to, and it does tend to be an inflation sort of hedge. At least that's what about 50% of those of you, when I survey you, seem to think or at least believe, which is good. Good transparency. We've got SoFi up 4.5% here. Very nice. Dutch Bros up 2.23 or 32. Hut 8 Mining's up a little bit, 1.82%. Let's see here. We have Hippo's actually up 1.42. It's had a little bit of a red streak. Beyond Meat sitting at just 101 for Beyond Meat. Kind of incredible. XL Fleet sitting at about 0.93 to the upside. Interesting with sort of the downgrade on Hyliion that XL Fleet would still be doing well. Neo sitting at about 0.69% to the upside. Not even holding a candle to what Baba's pulling off right now. Baba pulling off 5.37% on a very sort of epic rebound as those fears of China Evergrande's contagion really beginning to subside, at least. Recovery plays, Dave & Buster's, obviously the airlines, a little bit to the downside. Not much. Southwest is really the one who was getting burned the most here. And I bet a lot of that is really just fear that these walkouts or sickouts are going to continue happening. Delta Airlines, 0.73% to the downside. Spirit down 0.58%. Got 2 minutes to the bell. Let's take a brief listen here to Jim Cramer.
Actually, while it's not cheap, it is trading below where it should be. David, cold brewed.
Cold brewed.
Cold brewed.
Cold brewed.
So you have this day.
So he's talking about Starbucks. All right. So, all right. What else do we have? Let's take a look at some other headlines while we wait for the market to open. See if there's anything interesting. Look at that. Actually, this is a very interesting article. We'll look at that in just a moment. America needs higher, longer lasting inflation. Larger and longer lasting. Yes, that is what we all need. How Evergrande's rags to riches founder is trying to save his empire. World's energy chaos turns Russia into top emerging market pick. Clean energy stocks are being diluted by huge cash inflows. Yeah, you get big cash inflows into funds for emerging markets, and the potential returns for funds tend to disappear. All right, so California fire threat returns with Diablo wins and power cuts. Ooh, gotta love power cuts in California. Nothing like paying some of the highest taxes in the country and having your power go out. Yeah, that makes sense. All right, let's see what sticks here. So, all right. We are now about 15 seconds away from the opening. And let's go ahead and actually switch in back here and listen in.
Stock exchange on this holiday. Remember, people not working today. Yeah. By the way, doesn't mean, a lot of people not in the office, but that's just typical.
Yes.
More on that in a moment. cares so much about people not coming to the office? There's the opening bell. Here's the big board, ESS.
All right, here we go. An S&P 500 heat map. Looks like it's about 50. It's like, yeah, looks pretty 50-50 today. Maybe a slight red there. Let's go ahead and see how individual stocks are opening up. Let's go to the minute chart here just to see the open. Looks like Southwest pushing to the downside. I'll let too soon to tell. Alibaba pushing to the downside right on the open here. But DQ rotating up. It's Chinese energy and solar panel manufacturer here. You've got Steel Dynamics rotating up. Marathon, Hut 8 moving up slightly here. So you got your crypto miners moving up. Enphase actually up 1.83%. Somewhat of a surprise. You have DraftKings going green. This market tends to be pretty resilient on red opens, where it does like to try to go green. Looks like the S&P 500 is trying to do exactly that. Affirm was green in the pre-market. Looks like pretty flat right now in pre-market. Square is trying to push for some green as well. Okay, Hyliion's worsening, now down 8.25. And so is Southwest, down about almost 4% here. Etsy down 1.66. TMC, the metals, down 5.7. Affirm now down about 1.3%. So for some reason, Affirm doing a little bit of the sell-off dance, although it's hard to find it right now because it's bouncing around so much. Let's go take a peek at AMC. Opening volume is always funny. Yeah, there you go. AMC started off tiny little bit green there, now rotating down a little bit more sharply. Tesla in the green, but it is red candlesticking down. Shift Technologies rotating down as well. SoFi on a bit of a tear here, up 5.25%. DQ 6.8. Canadian Solar 2.6. Enphase 2. I'm surprised a lot of the energy companies are moving together here. Look at that. Solar Edge, Enphase, SunPower, DQ. Some kind of real push here on the energy plays, possibly as oil is skyrocketing. That we're seeing an opportunity in some of these stocks. Hut 8 mining all of a sudden up 4% as well. So a nice little push here on Hut 8. Yeah, if you work for the government, I think a lot of people are off today thanks to Columbus Day. I never got Columbus Day off as a child, so I ain't taking Columbus Day off today. Looks like there may have been a price upgrade on SoFi. Let's see if we can get a rationale. Pulling that data now. So, all right. SoFi climbs as Morgan Stanley initiates an overweight $25 per share. Let's see. It calls it a revenue growth story. Yeah, I really, really despise when companies call a stock a story stock. Like, oh, it's a good story. Because you know what company was also a good story, according to JP Morgan Chase? Nikola. The only way they could justify having the damn thing in their portfolio was calling it a story stock. And that's what I think is just like sometimes pathetic about the marketing that we face, because it's like, ridiculous. It's like, oh, I can't do a fundamental analysis on the thing, so I'll just call it a good story stock. Yeah, whatever. I think it's stupid rationale. But I do love the fact that Enphase is up 4% right now. A lot of these solar folks moving right now. Matterport moving. Again, makes sense when you get sort of a potential energy crisis like what we're seeing in oil. that you would see renewables move, but it's been a while since we've actually seen a move like this. Hyliion down almost full 10% now at 9.2, Southwest 4.2, Etsy 2.81 to the downside, and Affirm is down about 2%. United Airlines down 1.75. Affirm's one of those I'd like to add more to, but boy, oh boy, it's gotten quite expensive. Yeah, where's Disney sitting right now? That's another one I want to grow in the portfolio a little bit. Disney's down about 1%. Let's take a peek at Tesla stock here. Tesla's actually running a little bit. It's at 790 right now. Stocks are looking, or the sticks are looking good for Tesla, moving to the upside. Probably also an anti-oil play on Tesla. You've actually got Corsair Gaming up 0.5% today, and ChargePoint up 1.8%. Again, Matterport up 2.6, but also over $20. And the Enphase run, this is Alibaba actually, the chart here, 4.4% to the upside on Enphase, still doing well. The Enphase run, though, at the moment, continuing, sitting at 161 for Enphase. Not bad. And let's take a look at Hippo stock, not the warrants here. Hippo itself is actually down, and so is Lemonade. InsurTech getting beat up a little bit. Lucid, Square, Airbnb, Google, these guys dragging the indices. Well, they're not all in the indices, but these guys dragging down a bit. Apple, barely green, 0.06%. Yeah, FANG's really had a little bit of a rougher ride here. Let's go ahead and look at the headline indices again here as usual. All red right now, including the, well, it might be too early. It's too early to tell on the Russell. But worth mentioning that if you want to get up to $70 in totally free stocks, go to metkevin.com/public. metkevin.com/public to get a free stock worth all the way up to $70. And if you want to join me in my course member live streams where I talk options and trades, check those out in the course links down below, where you can get 41% off using that coupon code DiamondHands. Check it out. And again, metkevin.com/public for that up to $70 in free stocks. Okay, let's see what else we have on news here. Yes, we were going to review what America needs. Let's go ahead and take a peek at what America needs, which I think is honestly somewhat hilarious the way they've titled this. But you know, they got the good clickbait, so we'll give them a shot here. So this particular article is called "America Needs Higher, Longer Lasting Inflation." It is an opinion piece by Carl Smith. Personally, I always like to look up who the authors are. This is a Bloomberg opinion columnist and formerly the vice president for the Tax Foundation, which leans slightly to the right side, and a professor of economics at the University of North Carolina, co-founder of the economics blog Modeled Behavior. All right, let's see what Carl Smith has to say. All right, so Carl Smith tells us the administration of Joe Biden has repeatedly assured Americans that a sharp uptick in inflation is transitory and temporary. Yeah, okay. Not surprising that somebody from the Tax Foundation is starting off by bagging on Biden. But it is worth noting how political inflation has gotten. And that is because of the infrastructure package debates in Congress. Congress regularly tossing around inflationary concerns, where you actually have people like AOC, who I believe has essentially zero to negative financial education or knowledge, saying things like, oh, it's transitory, don't worry, we can spend to the moon. And there's like no adjusting her opinion at all. And then you have people on the right who are saying, hey, we can't just go spend trillions of dollars. We're in an inflationary environment, and the last thing we need to do is raise taxes to hurt the economy, the economic recovery, and spend more at the same time. But anyway, a survey suggests that the public is less convinced, but consumer expectations of inflation are notoriously fickle. Also true. Consumer expectations of inflation are a riot. They're barely worth mentioning. But anyway, all of this has economists and central bankers dutifully poring over data for signs of whether inflation, currently at just under 4%, well, I mean, depends if you read CPI, we're just over 5%, but okay, will drift back towards the Federal Reserve's 2% target. Instead, they should be considering a more fundamental question, whether the Fed should strive to make 4% inflation permanent. Ooh, it's actually an interesting argument that what if you just raised your expectations and you left rates low longer and you found inflation to be more acceptable? Now, inflation, remember, hurts individuals with consumer debt. So that would be debt related to assets that do not increase in value. So if you have credit card debt or student loan debt, inflation hurts you. It makes it harder for you to pay off your debt because you're not earning as much money. You're not net earning as much money. Whereas if you own real estate and there's a lot of inflation, your rents go up, your asset value goes up, and your debt actually becomes a smaller burden relative to the debt that you originally acquired, which is a wonderful thing. And it's a wonderful reason that I love hedging my stock portfolio with real estate. I really think it's an underappreciated balancing factor. But anyway, 4% inflation is the argument this particular professor is making here. To be clear, there's no doubt the recent rise in price growth has been an unpleasant shock. That's partly because it's so uneven. Prices on commodities like gas and lumber, along with a few select goods like used cars, have risen by double digits. A sharp increase in the price of even a small set of products creates far more pain than a rise of overall inflation, which is averaged across thousands of products. It's true, when we go through that inflationary list of what the CPI is reporting, it's just some sectors like women's dresses, right? Like we see like, oh my gosh, it's up 8%. These things can have this disproportionate push up on inflation. It's incredible. But narrow inflation is also the type of inflation that's more likely to reverse itself since it reflects supply chain disruptions. This is true. This is what Jerome Powell is regularly referring to, is anytime we have individual sort of sectors really showing inflation, but everything else more broadly not showing inflation, then that's good. And that reflects more of a sort of an acyclical type of inflation, which is basically a way of saying it's not structural. It's not something that's built into the economic cycle. Instead, it's something that's here because we don't have enough labor, or we don't have enough, raw materials to make certain goods, whatever. Or there's shipping delays, and that pricing will reflect back. Now, remember, some folks say, hey, how, if you can raise the price of gas to $10 and people will buy it, why would you not keep selling it for $10? What's to ever make that go down? Remember, this is where it's important to put your capitalist hat on, that the free market will push prices down as long as somebody can figure out how to manufacture something more efficiently or get something at a lower cost. Now, the issue of longer lasting inflation is when everybody is pushing pricing up. Analysts are concerned that the rise of inflation may be persistent because they see hints of a broader, gentler rise in prices across a range of goods, and crucially in wages. Wages is a great way to see prices go up on everything, right? Because you need people to sell essentially everything, either sell or make. Higher rate of inflation and correspondingly higher wage growth could be a net positive for the economy, says this individual, though. He believes that an increase in both wages and prices can lead to the dreaded wage price spiral. This is where if you raise wages, you'll have your input costs go up and the prices go up. This tends to be an oversimplified argument, though, that we really see because right now we're not seeing much of that spiral yet. We'll see if it happens, but right now it's a little bit oversimplified in terms of what's happening. So this individual talks about the two big reasons here: debt dynamics and higher inflation makes debt more expensive but easier to manage. It's when rates go up. A permanent increase in inflation from 2% to 4% would cause interest rates to rise by roughly 2% as well, as lenders sought to protect themselves from rising prices. Interesting argument, because in some sense, if this individual is saying that the Fed should be okay with higher inflation, like a 2% or a 4% inflation rate, then usually to accomplish that, they would keep rates low longer. But he's saying if inflation's running at 4%, then possibly private market lenders would raise their rates, because otherwise they'd be making essentially free loans. If inflation's 4% and you're lending it out at 2%, That's not going to make much sense. All right. One way to see how this would play out long term is consider the mortgage market. Higher nominal interest rates would mean higher monthly payments for any given loan. That might seem to make houses less affordable, but what's been clear over the last 2 decades and what economic theory predicts is that housing prices in the most desirable urban areas are determined by the maximum mortgage an affluent urban family can afford. Buyers in those markets bid against each other for a relatively fixed stock of housing. This is true. I mean, like you look at like coastline real estate in California, for example, it's very difficult to build more. Building in California in general is a complete disaster. And so you get this sort of concentration of potentially higher incomes where people are willing to pay higher prices anyway. And so maybe even though interest rates go up, you could still see prices move up in some areas. It's an interesting argument. Over the last decade, nominal interest rates fell. Families were able to take out larger mortgages, so maximum bids rose. Overall, buyers ended up taking on roughly the same monthly payment. Yet wage growth has also slowed over the last decade, so we haven't seen mortgage payments decline as a fraction of income. A modest increase in inflation and wages would reverse this process. This is where he's making the argument. So his argument here is really that as we are able to increase wages, maybe we'll finally actually start to see housing become more affordable over time as a percentage of individuals' income. And that's actually just his first reason. Second reason he gives for higher inflation would be, let's see here, higher interest rates giving the Fed more room to cut interest rates in the event of a crash. That's true. If you're sitting at 0%, it's kind of hard to cut interest rates. And goes on to say that the next recession hopefully will not be the result of a pandemic. And that means that Congress is unlikely to provide the same sort of level of stimulus. And so instead, we'll need higher interest rates to go into a recession. So that way we can cut rates if we need to. Inflation in particular, when caused by a sharp increase in a few products, is politically unpopular. A modest, sustained increase in prices and wages, however, would create a more stable U.S. economy by improving debt dynamics. It's an interesting argument. So this belief that, hey, if we raise our inflation expectations and we allow inflation to run a little bit hotter, then maybe we can allow wages to go up. People will be able to have lower payments as a percentage of their income. Kind of an interesting argument, and prep us a little bit better for a potential recession if we end up heading towards one. But in the meantime, we have had stocks run while we were taking a peek at this inflation dynamics argument. And take a look at this. We've got SoFi Technologies now up about 8.11%. That's an additional 3% just in the last few minutes here of reviewing an article here. Enphase up a beautiful 5% right now. Very, very nice. You've got a lot of the energy plays, Canadian Solar, moving up very nicely. DQ, very nice. Matterport's actually up a nice 3% as well. Very good. Wynn Resorts coming up 1.88%. That means Wynn sitting at 87.68 right now. Let's take a look at Wayfair. Wayfair is actually down, really sitting on this sort of potential support line here, down about 1.56. Taking a peek at some of the things that are getting beat up at the moment. Hyliion down about 9.72. Outlet continues to bounce back to about $4. Outlet down about 4%. Affirm down 2.9% at about 1.37. We talked about Wayfair, Shopify, Upstart, Lucid. These are some of the losing names today. Lion Electric. Boy, I haven't talked about that one in a while. AT&T sitting at just under $27. Keep in mind they did cut their dividend from some of those highs about a year ago. Boy, AT&T was something else a year ago. The dividend yield was incredible. Yeah, let's see here. Arrival, MP Material, SOS, GameStop, Fastly, up 2%. Starbucks up 1.56% on Tesla. Tesla up nicely. Bitcoin right now sitting at 57,200 on this higher inflation talk. Lots of fears. Lots of them, I say. All right. So, all right, what else do we have? And Let's go ahead and listen to Jim Cramer here for a moment. What do we got over here?
He likes your skepticism. You're a skeptic.
As is he.
I would call him a skeptic.
Yeah, well, Roger McNamee got the front page story there, too, on Time Magazine.
Yeah, well, that's
about Facebook.
But he does not influence the company. He owns Time Magazine.
They're not really saying anything. I think what they're saying is check out Kevin's programs on building your wealth linked down below, including programs on making YouTube videos, stocks and the psychology of money, options, trading, fundamental analysis, or real estate investing, property management. Check those out down below. All righty. So, yeah, let's take a look at Alibaba. Alibaba. I did invest a good chunk into NEO for some Chinese recovery plays. Though I have to say, Alibaba has been a little bit of the better play. Last 3 trading days, Alibaba doing very, very well, up 4.7% right now. NEO trading at about 1.62% up. So still up, just not as much. We are seeing Chinese and energy stocks do very well today. Enphase, for example, sitting at just 5% at the moment, with SoFi still sitting at about 7.5%. Slight minor little pullback here, but still doing extremely well, with Matterport sitting at that 3.75 level. Very nice. All right, so let's see what other headlines we might have. So, okay, we talked about America needing higher inflation for longer. Elon Musk tweeted Bezos a silver medal yesterday as they continue to poke each other. It's kind of funny. How California lost 1 million jobs and gained 332. Yeah, lost 1 million jobs by sucking and gained money by federal bailouts. Talk about that at a different time. So let's see here. Oh, did Charlie Munger say something about Alibaba? Let's take a peek. Alibaba. Let's see here. Alibaba. I don't particularly see anything about that, but it could be a little early. Okay. Launch announcement. Gosh, there's so much news on Alibaba all the time. My goodness. Let's see. Yeah, I don't necessarily see anything particular. But anyway. All right. So Munger increased his Baba position. Oh, the Munger thing was like 5 days ago. That makes sense. Okay. Alibaba, Charlie Munger. Oh, yeah, Barron's. Look at that. Oh, nice. Charlie Munger's firm doubled down on its Alibaba investment. Ooh. So Charlie Munger, obviously Warren Buffett's right-hand man here. Huge inspiration. A lot of people follow what Munger does. And it's worth paying attention to what Munger does. I completely support that, especially as a truly legendary value investor. It's worth watching what he does, and potentially, some people even say investing in some of your portfolio in some of the moves that he makes as a way to diversify your own portfolio. I personally was very tempted to buy Alibaba. I bought NEO instead, but NEO does not have that terribly low valuation that Alibaba does. And if anything, there might be a way to, quite frankly, diversify your portfolio with Baba as a play. And this is a huge, how should I say it, endorsement by Baba by Munger for Baba. Worth mentioning that right now, Alibaba is expected to have 27% growth next year, with an EPS coming in at about $59, which means we're selling for about 3x 2022 earnings, which is insanely low. And 2025 EPS expected to be about 104. So this, it doesn't make it makes sense to me that this is an incredible potential value play here. Yeah, let's go pull up Baba here. I've been tempted to do this, and I've been mentioning it for about 2 weeks now, as the Chinese Evergrande situation, in my opinion, has been relatively overblown. This is also just the day chart here before we go review what Munger potentially has said. But anyway, we're sitting at 167, which it's worth noting 167 is somewhere in line with levels that we saw pre-pandemic. There have been some runs pre-pandemic, and then of course during the pandemic we had a nice run to about 300 on Alibaba. But a nice bounce here off of the 138 to about 168 one right now. That works out to about a gain of about 21% so far. Some folks mentioned that it's too risky to invest in Chinese stocks, and there are a lot of risks investing in Chinese stocks. So there's no question about that. But let's go ahead and try to understand a little bit more about what Munger's up to. So let's get in here. Warren Buffett's longtime partner Charlie Munger disclosed that his firm has nearly doubled investment into Alibaba. So let's see here. The Daily Journal provides, let's see here. Daily Journal publishes newspapers and websites covering California and Arizona, produces, let's see here. Munger, he also invested in the Daily Journal. I see. Or he's the chairperson. He's the chairman of the Daily Journal. There we go. Vice chairperson of Berkshire Hathaway, chairman of the Daily Journal, providing insights on investing expertise. The Daily Journal disclosed last week in an SEC filing that it owns 302,000 shares of Alibaba as of the end of September, which means it ended up buying 136,000 in the third quarter. Interesting. So it's not like Munger perfectly timed the dip here, which is fair. I mean, you don't necessarily expect, but really it sounds like he was buying a lot in between July, August, and September as this dip was occurring. So quite frankly, if you were to buy now at 167, you're probably paying about what Munger was paying over the last 3 months. So that endorsement from Baba is not necessarily dated to the bottom pricing that we saw around the 5th or the 6th. Worth mentioning. And quite frankly, I think that's very interesting to me. Because usually, it's frustrating when you see, somebody doubled their position and then it's up 21% from there or whatever. But that's not the case here with Charlie Munger. So it does look like he declined to comment on those purchases. And Alibaba had fallen 35% during that third quarter, while the S&P 500 was flat. A lot of folks do give Charlie Munger and Warren Buffett a lot of heat for lagging the S&P 500 and wonder if they've lost their edge. But then again, with in China, you've had this insane ramp up of regulation. Alibaba invested in a self-driving startup as well here. They link an article. We can take a peek at that in just a moment. Last quarter, Alibaba started surging, possibly due to a broader relief rally. So far, up 9% in the quarter. And as we saw, 21% from its low there. Munger told the Daily Journal that they bought the stock with cash equivalents that would usually be invested in treasury bills, but returns on bills are now so low and its long-term prospects seem good. And does also note that a common stock is generally not considered a good cash equivalent, even though he's kind of making that comparison. He's basically comparing investing in Alibaba to treasury bonds, even though he's saying, hey, like, don't listen to this. It's not a cash equivalent. He's basically investing in Alibaba as cash right now. Just kind of an interesting way to think about it. So good job, Charlie Munger, on Baba. Although, again, he's kind of been averaging down. He's really been DCAing on this one, averaging to the downside. Let's go ahead and see how the S&P is reacting right now. Let's go pop the SPY. SPY sitting at about a third to the upside here. Very, very nice run here on the SPY. And we've got SoFi Technology still up 7%. Solar companies doing very well here, around 5% up on Solar Edge, SunPower, DQ. This is the Asian or Chinese solar company. See here at some of their numbers. They are up 9.93% right now on this broader energy bump. And EPS expected to be a little bit lower next year. Let's see, 10.69 next year, and actually decline. Wow, their EPS is somewhat declining. Bizarre. They must get some large contracts that really skew their numbers. Okay, that's gonna mean analyzing them is a little harder. Anyway, makes sense. Charlie Munger looking for some of those inexpensive opportunities. Affirm still down about 1.96%. Nominal, but it is still moved to the downside. S&P now nicely green. Let's go take a peek and see how CNBC is reflecting the market right now. Wow, look at this, folks. The market literally went green. We opened red, and we opened pretty nicely red, and good move here. Oh, very nice. 0.48% on the Dow, S&P now 0.43, NASDAQ 0.4, Russell 2000 0.23. Good job. Very, very cool. Sheep seems to be on a little bit of a run right now. And markets nicely green again here. Again, led by energy stocks, not the airlines. Tesla up 1.59%, NEO up 1.4%. Vehicle companies moving nicely. Yeah, Lemonade's actually positive, and so is Trade Desk right now. Very nice. All right, let's see if we got any other headlines here. In the meantime, remember to get your free stock with Public, metkevin.com/public, worth up to $70. And of course, check out the programs linked down below on building your wealth. Price does go up over time, especially since there's all this transitory inflation. Last time was about, $50? All right. China's property market faces a $5 trillion reckoning. That sounds scary. Tariff relief plans fall short. Yeah, a lot of folks were really hoping Biden was going to settle down some of the insane pressures with China, and things have potentially, as they're being interpreted now, gotten worse. Netflix to sell Squid Game goods on Walmart. Nice. So, all right. Well, good recovery in the market. Very exciting. I like it. Love buying the dip. And got green now. And so, folks, I would say that's it for right now. Thank you so very much for being here. Appreciate you. And I'm going to be going to the course member live stream after I make another cup of coffee and say hi to the little kids. So we'll see you soon. Thanks so much, folks. We'll see you.